All right, now, we all know that consumer confidence has had a bit of a rebound, but actual spending is down. Here to talk about that is James Cordier, portfolio manager of optionsellers.com, talking about the impact, really, of commodities on this. And it's interesting, your take, because we've seen such a great rally in commodities, but you think maybe there's not a sufficient base in the fundamentals for this rally.
Matt, it's hard to see where the supply-demand scenario allows for prices to be up double from where they were just this past March and April. Oil supplies right now in the United States are near a 20-year high. Heating oil supplies are at a 25-year high. And going into September, October, November is the weakest demand season of the year. The United States is still the largest consumer of oil, still by far in the world. And with the consumer cutting back and unemployment getting over 10% this fall probably, that's a whole lot less people driving, and that's a lot of gas that's going to pile up.
You know, James, we have these discussions a lot in the morning that we feel like there's a real disconnect between what's going on in the stock market and what's going on fundamentally. I mean, are people kind of missing really the story here?
We think they are. I think the reason why they're missing it is because we look at consumer confidence, which has just been increasing dramatically here the last few months, and I think that's what is happening is the citizens of the world, the United States, China, India, they're exhaling from the abyss that we were staring into this past winter.
Expecting a real rebound.
Well, yeah,
we're just happy that we didn't get the
We're finally
Armageddon.
comfortable. We now realize that the banking system is going to be okay. The banks aren't going to go under. These large financial institutions are done going bust over the weekend, and people are exhaling. And when they're being asked, how do you feel about the future? Well, they feel so much better about the future now because Armageddon has been avoided. But when it comes to consumer confidence is one thing. Obviously, that's very, very strong right now. Consumer spending is certainly a whole other thing. The consumer right now, we have him based two different categories. 25 to 30% of the homeowners right now, they just announced, 2 or 3 days ago, are underwater. That consumer is basically off the playing field right now. The other 3/4 of the consumers that have a positive equity in their home, they're probably more responsible consumers, and they're looking at unemployment in excess of 10% coming up, and they're going to hold back on purchasing.
So what's the result? I mean, this is why you see, and correct me if I'm wrong, leading indicators like the Baltic Dry Index continuing to come down.
Right. See, that is actual demand for raw products. Heating oil supplies, which is number 2 diesel fuel, it's growing to the largest supply figure in the last 25 years. Heating oil is what transports goods and services to people who are actually purchasing and taking delivery of this. And when you see electricity supplies and things like this and the price of electricity going down, there's no infrastructure spending going on right now.
Now, someone posed to me in terms of Baltic Dry that they said the reason the index is going down, that there's actually a lot more tankers out there, and so it's kind of skewing the numbers. I don't know if you think about that, if that factors into any of this.
It's hard to know exactly for sure. The Baltic figure right now is definitely an overview of what demand is right now, both in the United States as well as globally. And as long as that figure is as low as it is and going down the last 5 or 6 months, there's no doubt that there's less demand for raw products.
Didn't you talk to either FedEx or UPS in terms of shipping?
Well, they expect a rebound in the second half, but of course, it's kind of a different story, right, than the Baltic Dry Index and the raw materials. I wonder how you play this at optionsellers.com. I mean, what are you actually putting into action on the floor to make money on this?
What we do building portfolios for our clients is we sell options in the direction that we think the market's not going to trade. In other words, we're betting on where the market's not going to go. What that does is it allows an investor to participate in commodities without the volatility of the day trading and the large swings that happen, like in oil and gold and what have you. What we will do right now is we feel that there's probably a crescendo developing right now in commodity prices, and we would now sell calls far above the market. Gold right now is testing $975. It might get up to $1,000. We don't believe that's going to stay there.
Because you don't think it's going to go there.
We think it might reach $1,000 on some of this excitement. We're going to sell the $1,500 call for April, a price the market's never seen before.
Is it a dangerous play, though, if you're wrong? I mean, are your losses endless if you're wrong?
It's much less dangerous than playing the futures market. If you go short gold at $975, every dollar up, you're losing money. If you sell the $1,500 call for gold, gold can fall, it can stay the same, it can actually rally $200 or $300, and that option that you sold is still going to deteriorate in value.
All right, hey, James, thanks so much for joining us. James Cordier there from optionseller.com.